Joined now by Prashant Khemka, founder of White Oak Capital Group. Prashant, very good morning to you and thank you so much for speaking with us. You know, unbothered, largely speaking, is what Indian markets seem to be saying, and the message that they're giving investors. Is there trouble brewing under the surface that we're not really seeing right now? How are you looking at the way markets are responding to all of the action and events in the last couple of days?
Sure, Tamanna. Thanks for having me on the show. So actually, I'm a bit surprised. I would have thought today there would be a bit of a relief rally.
Oh.
Yeah, so we might see a green market. But reality is not that the market was beat up much on worries around the Middle East conflict. So maybe, there wasn't, it wasn't that much of a rally I was thinking, but my gut feel was that it might be green, but obviously the markets are down, as you can see on the screen, by a percentage point or so. The reason I felt it could be a relief is because I think the actions over the weekend, the developments over the weekend, and not going into geopolitics, because I'm certainly not an expert on geopolitics, if at all in any subject, not going into who's right, who's wrong. But I do think this would lead to, it would result in a relative period of calm, or a period of relative calm. There could be some ripples, but there's nothing that suggests to me that it would escalate into a wider conflict. No other countries got involved. Obviously, US got involved, but when US gets involved, that in itself may lead others to stay out of it. Yeah. So that's how I view it. I would have expected, now that there is this risk that people are talking about Strait of Hormuz, but very little that I know about Strait of Hormuz. While it is 20% of global oil transits through there, 80% of that, or more than 80% of it, is the destination is Asia. Largest one being China, then India, South Korea, Japan. None of these countries had a role to play in war. None of these countries, against Iran in any, did not express anything, or there's no history of any animosity with Iran. So yes, I've read that the parliament has approved, if the leader there decides to shut down the Strait of Hormuz, but it's not going to hurt neither Israel nor US. So I just don't know whether it's just a belligerent act of, punishing someone in the world, then it's a different thing. But it is a self-inflicting wound as well. It's like apne pairo pe kulhadi types. They are one of the biggest beneficiaries of oil transport through Strait of Hormuz, and the other beneficiaries are all Asian countries. So why would someone do that? It's hard for me, but as I said, I'm not a expert in geopolitical strategy or anything. But it would seem to me that's not a high probability event, and even if it does materialize, uh, I don't believe it is sustainable for any material period of time, because it inflicts more damage on Iran and other Middle East countries than anybody else.
Prashant, good morning. In some sense, what I'm trying to understand from your opening answer is that this could well mark the beginning of the end of the conflict, at least the one which has been the most recent one, which is involving Israel and Iran per se, right? And therefore, should that be viewed constructively for risk assets, given that the other conflicts still linger on?
I agree. I think you put it well, Niraj. It could mark beginning of de-escalation or end, because the main area of concern was for many years, and was the potential nuclear capabilities that Iran was building. If indeed those capabilities have been set back, nobody knows for sure. America or Trump has claimed that those, as he put it, obliterated those capabilities and all. If indeed that is true, then that risk is no longer a risk that Israel or America want to eliminate anymore. So Israel and America now, that yes, from our perspective, the job is done unless they find something contrary to their assumption that those capabilities are obliterated. Yeah, and once I think if America and Israel pull back, then it should lead to de-escalation of at least conventional warfare. Now there could be, that's why I'm not saying it would lead to peace, but it could lead to relative calm. On the surface, at least, the conventional warfare should calm down. Beneath the surface, it could be like there was in Cold War. Always, people are building their next step, but that could be very long period. It may not manifest itself in form of conventional warfare. Is my belief, naive belief, you may say.
Prashant, so then, from an investor perspective, it doesn't seem as bad, but no one, I think, is willing at this point to stick their neck out and saying all is well. We are in times where, you wake up.
Tamanna, the moment the market goes up 1%, everyone would say on your channel, all is well. It's just that market is 1% down. That's why people are assuming that market must be seeing something still of concern, and that is why all is not well.
No, Prashant, for a second, let's keep what the markets are doing today aside. Just the fact that, this was something that people didn't expect, that the US will actually go into Iran and bomb 3 nuclear sites and then wait and see what happens. We've not seen the what happens next. That's the only part that I'm trying to say. All right, you will keep this aside. We're 1% down. Should have been much more if there was any real concern as of this moment. But having said that, my question is then, is this a wait and watch kind of moment as you are looking at as an astute market reader? Is this a let's go all in while there is still turbulence moment? How are you feeling about the investment horizon in light of what's happening?
So certainly, I think, Tamanna, look, the oil markets, the way they have been behaving, and if you read and hear, obviously Trump is completely unpredictable for himself as well. So we can't say that based on his actions and comments, this was to be expected. But a lot of what he said over the last 2-3 weeks, and he was changing his comments in this direction, initially saying US has nothing to do with it. And then maybe in 2 weeks' time, he likes to keep that element of surprise. So it was building in the direction that US may get involved in some form or fashion. And they've done this in a clinical manner right now. Be that as it may, what is in the past, I think, yes, we always have to wait and watch how it comes through. All I'm saying is right now, based on what has already happened and what US is claiming that it is done, we are happy. We are satisfied with the outcome. Now, US is no longer the aggressor, and nor would Israel be anymore towards Iran. Now, Iran, whether it retaliates in a very aggressive form, it remains to be seen. And yes, that is a wait and watch. I am willing to, and obviously we are not betting anything in our portfolios basis this. This is just an entertaining, analysis of a geopolitical event. I would say that my bet would be that from here, regardless of commentary and maybe some actions which are, like minor ripples of the main event, but nothing that would perturb the market. And we should see de-escalation, at least from a conventional war perspective in Middle East, especially related to Iran-Israel.
Got it. Okay, Prashant, that's great. And Prashant, with your permission, I would also want to invite Mahesh, Nandurkar or Jeffries into this conversation. Just good to get both of you on the same platform and just try and understand how both of you think about it before we let you go, Prashant, because I know you've given us 10, 12 minutes, so we won't exceed it beyond. But Mahesh, we were just talking to Prashant, right? And he's saying that he believes that, one, he's surprised by the market reaction today. And in his wisdom, this might well be the beginning of the end of the conflict. And Prashant, I hope I'm not misquoting you here, but Prashant believes that that might be constructive for risk assets by and large. Now, what is your sense, Mahesh?
Yeah, hi Niraj, hi Prashant, hi Tamanna. So I would agree with what Prashant said in terms of the market reaction today. We've been watching the region as well. I think the the market movement even from the region is not really that scary. Oil prices are up, but yes, they're up about 2% or so. So again, not scary. So I would tend to go with what Prashant said, that from the reaction that we've seen for today, it looks like not a scary scenario. Uh, but whether it's a great news for the market from the medium term to long term perspective. I mean, the event itself probably is not turn out to be as scary as we just discussed. But obviously, outside of the event, there are many other things, which is the valuations, the earnings growth, what we're seeing in the corporate earnings and so on. And I think, and more so the corporate equity supply as well, and keeping all those things in mind, um, I would say that it's not very easy to take a very bullish view on the markets at this point in time.
Not easy to take a bullish view, perhaps, and I want to come to some of those other factors with Prashant very quickly. Look at the advanced tax numbers that have come out, muted to say the least. Yes, the RBI is trying its best. We've had some push coming in from the RBI, but they did change their stance back from accommodative to neutral. Do you think that from an Indian perspective, maybe there are not bigger fish to fry, but other problems that we need to tackle as well before we head into Q2 and get more cues from there on corporate earnings?
Yeah, so, Tamanna, these are all part and parcel of what I call conventional macro, and I think historically they've not really moved much the market. These are how many times, Tamanna, you see over the last 2, 3, 5 years, you would have uh, muted numbers from advanced tax or from GST collection. Sometimes they're strong, sometimes they're weak. These are just day to day. Even if they move the market, they might move by some basis points, 5, 10 basis points, which would not be evident from watching the market because there's just normal volatility there. So I think they're all part and parcel of normal life. And we don't really follow these so much. So I don't have a very or any view on the impact of these. I think earnings growth through all this should, because you have like dozens and dozens of these factors, right? The monsoon is good, something else is poor, and so on and so forth. So I think low double digit earnings growth for the coming year is reasonable expectation, and that's good enough for market where it is currently valued at the average of last 10 years, 10, 11, like from 2014 till now, last 11 year average is about 20, 21 times, which is where the market is today on forward 12 months number. So it's a normal valuation for a average kind of earnings growth over expected, not just over the next 12 months, but I would say looking forward for years to come.
Um, Mahesh, just want to get your sense about the kind of appetite that you expect to see going forward, looking at what's happening in promoter stake sales, what's happening in the private equity space, in the IPO space. Do you see that cash squeeze continue? And what are you reading in the tea leaves when you see so many promoters coming in to maybe cash out?
Yeah, so the equity paper supply, in my view, is a reasonably large factor for all of us to keep in mind. I would say that the second half of last calendar year, which is between July to December last year, we saw a pretty big jump in the equity paper supply, and our calculations suggest that it was upwards of $7 billion a month. And this time around, we obviously started the year on a quiet note because the market itself was not really doing that well. But in the month of May, we saw about $7 billion of money being raised. June is moving towards that direction. And from what I understand, if the market stays where it is, then probably this type of supply will be continuing going forward as well over the next several months, and which I think in turn will probably cap the market return. So that's is one of the reasons why I feel that I feel that the markets may not really move dramatically upwards from here on. The demand side for equity, which is the flows that we talk about, the domestic flows, the foreign flows, I think those are on the positive side. Although the domestic flows, understandably so, have come down somewhat, but still in the net positive zone as we speak. The foreign flows have turned positive over the last 2-3 months, and I would say that my interactions with global investors suggest that there is an incremental interest, coming towards, I would say broadly the non-US markets like the European eventually should flow into emerging markets as well. And India is obviously one of the more prominent of all of those. So that's been on the positive side. So that I think story is well flagged, but I think this equity supply is something that we need to keep in mind. I would broadly say that it's not such a bad thing for the equity supply to have increased, because I think this will also help keep the market valuations under check, in my view.
Okay, Prashant, before we let you go, and it's an interesting point that, of course, Mahesh has spoken about as well. Two factors to this, because you are also an investor into global markets, which are competing with India. And at the same time, you're a recipient of flows from your investors who might want this India exposure in a meaningful way, right? How do you see this playing out? When you are looking at a GEM fund, are you increasing or decreasing the allocation to India? And what do you hear from your clients, Prashant, about the feel to invest into India or non-US assets, as a lot of people, including Jeffrey Gundlach, has said that, put money into India and don't look at the tape for the next 30 years and you will benefit, etc. How do you think about it as an investor?
Certainly. So see, in our EM fund, we are usually, and our clients also, expect, or we've set that expectation with our clients also, to expect India to be almost always be a higher allocation than the benchmark. So over allocated to India. It's not necessarily a top-down bullish view that India would outperform the rest of the world or anything. It's just that the bottom-up alpha opportunities, the opportunity to outperform the market, we find more compelling numbers in India, larger number of such opportunities in India, and also where our capabilities are the strongest. We have a home ground advantage in India as well. So it is overweight, but for different reasons, not necessarily because we believe India would outperform. We, consistent with what Mahesh was saying, I would say that we expect India to deliver moderate or average returns, which it has delivered historically, which is low double-digit returns in rupee terms, high single-digit in dollar terms, which is not expected to be too different from what other emerging market countries may provide at an index level. But at a stock selection or at a portfolio level, we expect the alpha or outperformance in India to be stronger given the capabilities we have and given the nature of the Indian market.
Prashant, thank you so much for your time and extension of your time here. And we really enjoyed that conversation with you and Mahesh, but we'll let you go.
Always a pleasure, Tamanna and Niraj, and good to see you, Mahesh.
All right, so Prashant Khemka there. We'll continue the conversation with Mahesh Nandurkar, of course. And Mahesh, I just want to pick up from what you said last, where you said that the interest from foreign investors is beginning to shore up when it comes to India. Where is that interest going? Because your typical sort of destinations, your BFSI, is not showing that kind of spark. Do you think that there are underlying worries there? What are you liking right now when you see, the markets from an India perspective?
Yeah, so you're right. So typically, the large FPI flows, when we see the tides turning, it usually goes in favor of BFSI segment, as you rightly mentioned. But I think, this time around, I think the key point to note here is that despite the fact that we've seen such a large rate cuts by the RBI, and the fact that it is likely to have a negative near-term impact on the bank's EPS because of the net interest margins going down, the banking sector has actually performed in line with the market, actually slightly better than the market. So in fact, I would say that the large banks that did underperform for a period of time, year to date in this current calendar, they've actually done reasonably well. And we were expecting it to be that way. And I'm glad that it has turned out to be that way. So I would say that from the foreign investors' point of view, banks and also I would say NBFCs would continue to be one of the areas that would look interesting to them. Also, from the valuation standpoint, while one would argue that the current MSCI sort of index trading at about, let's say, 22 times 1 year forward earnings is about one standard deviation higher than the last 10-year average, but the average at the index level have been held down because of the banks. If you actually take the BFSI segment or the banking sector out, the 1 year forward earnings multiple for the market as a whole would jump up to 26 times, which is quite steep. So it's the valuation comfort and also the fact that the RBI has turned significantly pro growth as compared to the stance that it had most part of last calendar year is also a big positive for the lenders, for the BFSI segment as a whole. So that does remain one of our most attractive sectoral bets.
Got it. Got it. And yeah, I mean, with the new Reserve Bank of India, it seems to be a different landscape altogether. Mahesh, the other factor is whether this whole geopolitical piece that continues now in such a wide fashion, despite the hopeful de-escalation, at least with Iran and Israel, does it make the richly valued defense stocks still stay center stage in the minds of investors and firms like yours, which are writing notes on these companies? Do they occupy mind space?
They do, and I think it would continue to do. It would continue to be that way, in my view, because increasingly what we are seeing is that there are more and more such instances that we are seeing over the last 2-3 years. And as far as India's defense expenditure goes, I would say that the defense capex as a percentage of GDP today is at about 50 basis points. Over the last 20 years, if you see, it has ranged between 50 basis points to 1 percentage point of GDP. And given all the geopolitical tensions all around the world, also in the subcontinent, I think even for India, it needs to be towards the higher end of the historical range and not the lower end. So my sense is that over the next 5 years or so, I would expect India's defense capex to be rising by 25% CAGR. And plus, on top of that, there are other things like Make in India, and there are some small examples of Indian armaments being exported as well, etc. So there is a pretty strong growth outlook for many of the companies that are involved in this defense space. And I hear what you said completely, that the valuations are rich and it's going to take some time for the order book to grow and etc. But I think from a thematic perspective, it still makes sense to be positioned in that space.
So we've talked about BFSI, you're constructive, defense, you're constructive. How are you feeling about IT, Mahesh?
IT, we are not feeling that constructive. So it's a sector that we have been, underweight on. And I think, given where the stocks have moved up very quickly in the last, 1 month or so, towards the higher end. In fact, almost like 1 standard deviation higher than their historical averages. And clearly, the economic outlook in the US is not really very conducive in terms of the discretionary capex for the large US corporations to be rising at this point in time. In fact, one of the large companies that just reported results over the weekend, the numbers were actually, not that great, and they've ended up cutting the guidance as well. So my sense is that given the combination of pretty richly valued, PE multiples, and combined with that, the fact that the outlook from the US corporations increasing their discretionary capex doesn't look that great, we would be underweight on IT services.
Just on Accenture, Mahesh, a follow-up there, because, the way Accenture read from brokerages as well, this morning as well, it didn't seem half as bad. Which is why just a little bit more of elaboration there from you. Growth guidance 6 to 7%. What, if you had to narrow down or pinpoint, what is the concern or the red sign or the red flag that you're seeing there, which is of course a spillover for Indian IT?
Yeah, I unfortunately cannot talk about individual stocks here, but what I would broadly speaking say is that The fact that the growth guidance was brought down, um, and as I mentioned earlier, what we really need for the Indian IT services companies to to kind of outperform going forward is the confidence that the discretionary capex from the USA is going to be rising, and we are not getting that comfort at this point in time.
Okay. Mahesh, one final word, and which is that what's the dark horse here? I mean, in a market which you don't anticipate to go so high, and some of the usual suspects like BFSI and defense being top of the mind, if you will, is there a dark horse, something that you guys might be a minority on, either on the bullish side or on the bearish side?
Yeah, so on the bullish side, I would say apart from these two, the other sectors that we like are telecom, um, I would say cement, and also two-wheelers. So those are the other three sectors that we like. Now, one might say that telecom is not really a dark horse because it's a sector that has already done quite well. So yeah, maybe not. I would also highlight cement, as a sector here, because I feel that the pricing environment in cement has turned around, and I think cement pricing is really the key for the stocks to perform. And my sense is that after remaining subdued for a very long period of time, for nearly last 10 years now, in my view, the cement pricing is showing some initial signs of moving up. So I would say that can be, a pretty strong dark horse going forward. And one of the factors that I wanted to sort of support that thesis with is also the fact that if you look at, and it's a slightly different angle, a differentiated angle, which is, on the GST side. So we all know that when GST was implemented, back in 2017, there was, a 5-year window that was given for the state governments in the form of GST cess collected on some of the categories and distributed to the states as a way of compensation. And that was supposed to get over by 2022. But then afterwards, because of the COVID that came in between, there was a shortfall, and then that compensation period was extended, through to like March 26. So it's basically this current financial year, FY26, is the last financial year, wherein that compensation will be paid, and which basically means that almost a $20 billion annual GST cess collection will be surplus from next year onwards. And government has a lot of options to use that $20 billion. I mean, one is obviously upping the defense sort of capex, bringing down the fiscal deficit, and variety of other things. But specifically in case of GST, also I see a strong case for the GST on some categories where it's sitting at a very high level of 28%, can be viewed. And I would say two-wheelers and cement are the two sectors where there's a possibility of that being sort of viewed. So that's an additional point, for cement. But as I said, the basic thesis that we have is the pricing environment has started to improve.